Good morning everyone, it's me Ali and I warmly welcome all of you in another forecast video of the precious metal gold. Guys, the market is going to offer us some high impacted economic events this week. Since this is a new week, so we may have some major economic events. For example, the eyes will be on the advanced non-farm payroll, which is ADP, and by the end of the week we are going to have non-farm payroll, which is expected to be mixed. Actually, the unemployment rate is expected to drop down, while the NFP is expected to report lower new jobs that has been added during the last month. Besides that, the average hourly earnings are also expected to drop down, which is negative for the US dollar. So we can expect US dollar to trade with a bearish bias in this particular week. Anyways, looking at the precious metal gold, guys, during the last week the precious metal gold has violated the downward channel, as you can see here. The market has formed the downward channel on the 4 hours time frame. I will then later on move towards the 1 hourly time frame so that we have the idea of on the intraday basis. Anyways, the channel was providing a solid resistance somewhere around 1965. Now let me move back to hourly time frame. Okay, so as we can see here, guys, the market has closed bullish engulfing candle right after breaking out the downward trend line here. So in such situations, market can take a dip. Market can drop until, like, let's say 1963 level, and after testing 1963 level, market can again show us an upward trend in the market. Okay, this why market is expected to drop down, by the way, guys. Whenever we have a bullish correction in the market, or a dramatic buying in the market, investors mostly go for profit taking, and if that happens, then in this particular case, market is likely to show us a bearish retracement. And on the lower side, the downward trend line, which has already been violated, is likely to work as a support level for now. Previously it was working as a resistance, but since it has been violated now, this is going to work as a support level for the precious metal gold. So with that being said, the closings of candles above 1963 level is likely to offer us further buying trend in the precious metal gold. This is what the technical side of the market suggests. On the higher side, the immediate resistance is going to be found around 1976 level, while the bullish breakout of 1976 level is likely to lead precious metal gold prices towards next target level of 1988. Okay, this is the bullish stance of the gold. And honestly, I believe that the bullish bias is more dominant in the market, and we may see further buying trend in the market. But once again, we have to keep an eye on the MACD as well. The MACD is showing us a bearish crossover. The histogram is likely to be formed below zero level. If that happens, there is again odds that the precious metal can take a dip as well. Well, I'm considering that this dip is going to be equal to 1960, like 1963 level. However, if market manages to break below this particular level, the next support level for gold is likely to be found around 1954. Then we can ignore this particular trend line, because it would mean that investors are not considering the downward trend line anymore. So we can say that if we try to apply a Fibonacci retracement here from this level to this level, market can go after. If market breaks below 23.6% Fibonacci retracement here, we can expect precious metal gold to drop towards 1954 level, which is extended by 38.2% Fibonacci retracement level. Anyways, guys, long story short, let's keep an eye on 1963 and on the higher side 1976, because this is going to be the this is likely to be the range of the precious metal gold today. So guys, thank you so much for following us. Keep following, because there are going to be more updates from our side. See you guys soon. Until then, have a very profitable session. Bye bye everyone. That's all. Have a very nice weekend. See you guys next week with more forecast videos. Take care, guys. Bye bye.